Hello there. This is Tejas from Trendline, and in this video, we'll be discussing the fast changing dynamics of crude oil and natural gas, the factors affecting their price movement, and also their impact on oil and gas sector companies in India. Let's start with the factors affecting crude oil and then move on to the different outlooks on crude oil prices from foreign brokerages. Expected prices by JP Morgan and Citi vary from $380 per barrel to $45 per barrel. This is a very large difference in opinion, and we'll try to understand the rationale behind these figures. We will then take a closer look at where exactly crude oil from Russia is being consumed after many countries impose sanctions on the Russian Federation. Finally, we'll analyze the impact of crude oil prices and export duties on the oil and gas sector. While a rise in crude oil prices can help upstream companies to improve their profitability, the Indian government has introduced a downside by levying export duties on oil products such as petrol, diesel, and aviation turbine fuel. With regard to downstream companies, elevated oil prices can squeeze the margins, and additional export duties from the government can further impact their bottom line. Crude oil has been on the news since the geopolitical tensions began in Europe from February 24th onwards. Brent crude oil reached over $135, a 14-year high on March 7th, fearing a shortage of Russian crude oil supply due to the sanctions imposed in response to the tensions in Eastern Europe due to ongoing conflict. Crude oil rose because Russia is the third largest oil producer in the world, accounting for about 11% of the total oil production and is the biggest oil exporter to Europe. Apart from the geopolitical tensions in Europe, another factor affecting the crude oil price is the fear of a looming recession in the US and Europe, induced by the aggressive rate hikes by their central banks to reduce the high inflation. A recession or even an economic slowdown in Europe and US can reduce demand for oil and in turn reduce prices. In addition, there is a fear of economic slowdown in China, along with concerns over strict COVID lockdown waves that may affect the demand. Any demand reduction from China will have an impact on the crude oil prices. This is because China is the second largest consumer of oil after the US. Given the several complicated factors affecting its demand, the movement in crude oil prices is very difficult to predict. The divergence of views can be seen in the foreign brokerage reports. JP Morgan believes that if the G7 countries cap the price of Russian oil, Russia may reduce its oil exports significantly by 5 million barrels a day, which will push the crude oil prices to $380 per barrel. However, Citi has a different outlook. Rather than the reduced Russian oil supply, Citi says if a recession in the US and Europe happens, which is looking more and more likely, crude oil prices may fall to $65 per barrel by 2022 and potentially to $45 per barrel by the end of 2023 due to a severe cut in demand. These views are quite divergent because there are a lot of moving parts that can affect the price of crude oil. This is mainly due to the impact of sanctions and price capping by G7 countries. What's more important is how Russia will react to any move to capping prices. Let's now have a look at where the Russian crude oil is going. So, several sanctions were imposed on Russia and its crude oil exports by the West. The narrative is that only Asian countries like China and India are buying Russian oil after conflict broke out in Europe in February. But if we look closer, it becomes clear that European countries are still importing Russian crude, albeit at a lower rate. If you look at Russia's seaborne oil flows, which exports about 3.12 million barrels per day, Asia accounts for more than 50% of total shipments. However, Europe still accounts for 41% of Russia's seaborne oil flows despite the sanctions. For context, Asia accounted for 33% of the shipments before the conflict erupted in Europe in February. While Europe trimmed its oil imports, it still imports 1.39 million barrels a day of Russia's seaborne crude oil. With regard to Russia's North European customers, the Netherlands, Poland, and Finland continue to import Russian crude, while the UK, Germany, and France have seized Russian crude imports. China and India continue to be the largest buyers of Russian crude oil and are the second and third largest oil consumer in the world, respectively. Both countries have increased their imports of Russian crude oil. Russian crude oil now accounts for 10% of India's total crude basket, up from 0.2% before the tensions arose in Europe. However, if we look at countries around the Mediterranean Sea, Italy, Turkey, Croatia, Greece, and others, 4-week average shipments of Russian crude oil soared after the tensions began in Europe in February. Italy's imports rose to 0.33 million barrels per day in July from 0.12 million barrels per day in January. This clearly shows that India and China aren't the only countries that have upped their Russian crude imports. European customers like Italy, Turkey, and the Netherlands also continue to import Russian crude at a large scale. Now that we have an overview of the key drivers affecting the crude oil prices, let's look at how these will impact various companies in this sector. Companies operating in oil and gas sector can be classified into upstream, midstream, and downstream. These terms basically refer to an oil company's location in the value chain. Upstream oil and gas production is conducted by companies who identify, extract, or produce raw materials. Major listed companies in this space are Oil and Natural Gas Corporation or ONGC and Oil India. Downstream oil and gas production engages in anything related to post-production of crude oil and natural gas activities. Some listed companies in this space include Bharat Petroleum Corporation or BPCL, Hindustan Petroleum Corporation or HPCL, and also Reliance Industries. But Reliance can also be classified as an integrated oil and gas company as it operates in both upstream and downstream spaces. Finally, midstream companies link upstream and downstream and include transportation and storage services. Let's start off with the listed upstream companies in the exploration and production industry. The two big players in this space include Oil and Natural Gas Corporation and Oil India. Reliance can be classified as an upstream company as well, as it is also involved in the drilling and production of crude oil apart from refining. Upstream companies are expected to post a sharp uptick in earnings due to higher oil and gas prices. However, on July 1st, the government imposed an export duty of rupees 6 per litre tax on the export of petrol, rupees 13 per litre tax on the export of diesel. An export duty of rupees 6 per litre tax was also imposed on aviation turbine fuel. And finally, a rupees 23,250 per ton cess was levied on crude oil produced domestically. These additional taxes on exports are aimed at shoring up domestic supplies at petrol pumps, which had dried up in a few states. Let's start off with the heavyweight Reliance. As exports contribute over 50% of Reliance's refined products, the export tax could dent the gross refining margins or GRM, but earnings are expected to be resilient. GRM is the difference between the total value of the petroleum products coming out of an oil refinery, which is the output, and the price of the raw material, that is input, which is the crude oil. Analysts estimate the export taxes to reduce overall GRMs by about $10 per barrel. Further, the purchase of Russian discounted crude can also add $2 to $3 per barrel. As per media reports, the finance ministry is likely to conduct a fortnightly review of export duty. Another term that is used in the oil sector is crack. It is a term used in the energy markets to represent the difference between crude oil price and the prices of wholesale petroleum products that derive from it, such as jet fuel, kerosene, home heating oil, and gasoline. This is especially high for Reliance as its refineries have the capability to refine different grades of crude oil efficiently. In addition, the petrochem sector profitability is expected to be hit by higher input prices. With all these factors in the mix, Reliance's consolidated revenue is expected to rise 12% quarter on quarter or QOQ in Q1 FY23, and net profit is also expected to rise by 29%. If we refer to the year-on-year comparison, revenue is expected to rise 59% and net profit by 84%. We are looking mainly at the QOQ data here due to two reasons. One is the situation in Europe arose in the previous quarter, leading to a very volatile crude price. On top of that, year-on-year comparison will be on a lower base because of the lockdown in the previous year. The other two major upstream companies, ONGC and Oil India, are also affected by the export duty imposed by the government. On July 1st, in reaction to the export duty imposition, ONGC fell 13.5% while Oil India fell 15%. Despite this export duty, ONGC and Oil India are expected to post strong revenue growth in Q1 FY23. In terms of standalone numbers, ONGC's Q1 FY23 is expected to rise 20% and net profit to increase by 40%. While Oil India's revenue is expected to rise 23% Q on Q in Q1 FY23 and net profit to rise by 22%. Earnings are expected to be driven by higher gas and oil prices. However, export duty may play spoil sports in the short term and affect the Q2 FY23 profits. Let's now move on to the downstream companies, namely BPCL, HPCL, and Indian Oil. The revenues for these companies are expected to rise Q on Q in the range of 12% to 15% on the back of strong demand. However, even though revenues are expected to rise, a price freeze for auto fuel and LPG amid soaring commodity prices has led to a rise in under recoveries for oil marketing companies in Q1 FY23. Under recoveries are the losses incurred by the state-owned companies for selling their products at below the cost price. One silver lining here is that strong GRMs and high inventory gains may partly make up for the weak performance of the marketing division. The net profit of all these companies is expected to fall anywhere between 35% to 55% in FY23. Finally, let's have a look at few major gas utility companies, GAIL, Mahanagar Gas or MGL, and Indraprastha Gas or IGL. Let's start with GAIL. This company can also be classified as a midstream company, as it is in the transmission business as well. GAIL's revenue is expected to rise moderately by around 6% Q on Q and its net income to fall by 14%. If you look at the other two companies, IGL and MGL are expected to post healthy quarterly revenue growth of about 21% year on year in Q1 FY23 on the back of rising demand. Regarding the net profit, MGL's net profit is expected to rise in Q1 FY23, while IGL's net profit, like GAIL, is estimated to fall about 17% quarter on quarter. This is due to the difficulty of the city gas distributors to pass the rise in input costs on to customers. Because of this, the profitability of the gas distributors are getting impacted. One common theme that we saw across the oil and gas sector is the effect of export duty imposition by the center on companies' profitability in a huge way. A rise in crude oil prices can help oil and gas producers as it will improve their profitability. But downstream companies' margins will get squeezed due to a rise in input costs. Although retail fuel prices are market linked, PSU oil marketing companies have not raised prices. To offset this, they were exporting fuel to get better prices abroad. But the export duty imposed on July 1st negates any exorbitant profits they may earn through exports. On top of that, factors affecting oil prices alone are very difficult to predict, as there are a lot of moving parts involved, ranging from sanctions and price capping plans of G7 countries to Russia's rebuttal to the decision. We'll have to wait and see how this will unfold going forward. So this was the analysis of the oil and gas sector in India. This is Tejas signing off.